And so people made adjustments, and that I can't say that was not the best approach, but they moved into cash or cash equivalent positions. The problem is they got so paralyzed based upon what had happened that they never re-engaged back in the market.
They never left the cash position.
They never left the cash position.
Welcome, friends, to Invest in Faith, where faith meets finance in the most practical ways. In a world that feels more uncertain by the day, there's power in bringing together spiritual guidance, practical application, and intentional living. And that's what we're here to do. I'm Bradford Hancock, joined with Michael Wallin, and we're honored to be your guides on this journey. As a certified financial planner and the managing partner of Optivize Advisory Services, Michael serves financial, tax, and estate clients across the nation, bringing clarity through biblical principles. After this episode, go to investedinfaith.com to connect and learn more. Hello, Michael. Good to see you again.
You too, Bradford.
From the last show, you dropped a little nugget, though, I wanted to come back to, and it talked about how to achieve a successful retirement. Can you come back to, do you know what I'm talking about?
Yeah, last week's show was a great show, and I think it really leads into the discussion we're going to have today. And, you know, we were talking a little bit about behavioral finance and what causes people that emotional dynamic. And we were talking about what really leads people to having a successful retirement. And it's not making mistakes. It's not overreacting, not getting too emotionally involved with the movement of the market.
Okay.
So one of the things that I find, and this is what I try to coach my clients on, is really understanding the difference between a bank statement and their investment statement.
Okay.
Okay. So bank statement, let's just use that as a baseline at first. Bank statement comes out, and we'll just use nice round numbers here. Let's say you had $10,000 in the previous month in your bank account.
All right.
This month, you've got $9,000. Okay. There is $1,000 less. You don't have that extra $1,000. That is your real money. Bank statements are based upon money. It's what you have. Opposite of that is an investment statement.
Okay.
So your bank statement, whatever's on that page is how much money you have. And too often, investment clients will come to us or call us when all of a sudden they've opened up the envelope, they've looked at it, and they're saying, oh, my account has changed in value. And that's a very important phrase to state. It has changed in value from last month to this month. What typically happens is a client will call up Bradford and say, hey, Michael, I lost $12,000 last month. Nope, you didn't. You did not lose $12,000. You had a change in value of $12,000 because an investment statement is a statement that looks at assets that you own. It does not look at how much money you have. It is assets. So let's talk a little bit about different types of assets that you may have. You have a home. You have automobiles. You may have jewelry. You may have some kind of collection. You may have tractors. You may have landscaping or lawn care. Those are assets. You bought those items. Now, what is the value of those assets? What somebody is willing to pay for them. Okay, so when a statement comes out from an investment company, all it's doing is taking a snapshot of what you could have
sold. If you took action on that, if you executed a sale, that's what you would get for it.
That's right. Okay. If you would have executed a sale on it, that is the most critical part of it. You sold it for what it was valued at that moment. Now, that might be less or it might be more than what you originally paid for it. But if you still own it, you did not execute a sale on it, then you still own that asset. This month, it might be worth more than what you originally purchased it for. So an investment statement only takes a snapshot of what you could have sold that piece of property for at that exact moment. Well, the market is always changing in price. So a stock or a bond or your home, whatever that asset that you have is always changing in value. Mm-hmm. So you can't look at an investment statement the same way you look at a bank statement. Now, why is that important? Because if you don't truly have a plan, and we talk about Stephen Covey, we talk about the begin with the end in mind.
Right.
If you don't have a plan in place and you treat all of your assets exactly the same, now we don't do that. We look at it in a different approach of saying, if I'm not going to deploy all of my resources in the same year or the same time period, I probably should have a different strategy on each different bucket of money, because I have a plan that I'm going to live a number of years during retirement. And I should earmark an amount of money that I have saved to go into each of those buckets. What that keeps me from doing is having a reaction. When I open up the investment statement and I see a market correction, like we talked about in the last show, we have expansion
in
peak.
April of this year.
Yeah, just the example we've had of this year. How many people sold out on March 27th or March 28th because the market started going into a correction? Well, why would you do that? Look at how much you would have missed out on when April 2nd hit and the market started coming back up. Well, people that sold out and went to cash missed the return of when the market started expanding back. Well, if you are properly allocating your money into different buckets, then you don't have that emotional tie. You open up your statement and you go, well, money I'm not going to use for 10 years from now. Well, it's had a correction. It might be down 10%, which is a normal correction in the market. A 10% correction is going to happen every 15 months.
So having some patience and having like the long view in mind here.
And understanding that it's just a snapshot. That investment statement was only a snapshot at that moment it was printed of what that asset was worth.
It's like a blood pressure reading.
Absolutely.
Okay.
You could take 3 blood pressure readings and they're going to all 3 be completely different. If you give enough time, you're going to get a different reading of what the value is.
I think that's an important part to distinguish too on the statements, because I think a lot of people, me included in the past, would look at that statement from my investments and think, oh no, I'm losing money, or hey, great, I've made a lot of money. But it's really what you have when you execute the sale. That's it's what you're selling it for at that point.
Sure. Well, I think that's a great point. When you look at it, it's what choice do you make after you open the statement? If you open the statement and you acknowledge, hey, we're in a market correction, it's a great time to buy.
Everything's going to be less expensive.
Everything's less expensive. So if you have money that might be sitting on the sidelines making 2% or 3% in a bank account, that might be the opportune time to transition that money in and dollar cost average by buying some additional positions, either in an equity or bond market, to increase your opportunity for success in your investment portfolio. But what you can't do is open that statement having an emotional feeling and abandon the strategy that has been working for you. Just because the market corrects does not mean your investment strategy is not working. It just means that it's going through its natural process of expansion and contraction. And, we tend to see the market over a period of time move up and to the right. Mm-hmm. What it does tell you is if it's money you're dependent upon to pay your bills this month, then that portion of your investment account is not invested correctly, because that portion of your money should not be invested into positions of high volatility. But money that you're not going to use for 10 years, how many times is the market going to expand and contract over a 10-year period? We know the market tends to contract by 5% positions, 5% contractions, at least 2 to 3 times a year. And 10% contraction once every 15 months is the average. When you go into an investment plan, you should expect that. But don't let that envelope that comes out from the custodian to be a powder keg for you. But when you open it up, you ignite it and you blow up your plan.
What advice would you have for people who check an app daily versus a statement that's monthly?
I think that sometimes they cause themselves undue stress. You talk about blood pressure. I think checking your investment account, something you cannot control every single day, may not be the healthiest thing for someone to do. I think if you build a proper plan with high expectations of how it's going to be achieved, you can let your mind rest and let the financial planner that you've hired, let them be responsible for navigating it. Let them be your chief financial officer. Let them be the responsible party to navigate through that journey. And if you're in retirement, go do those things that have brought you the most joy in life.
And you're not saying neglect it. You're saying let a professional who's working on your behalf handle that for you.
Absolutely. Have tactical and strategy sessions with that financial planner that you've hired. Have them walk you through. You can't change the past. If the market has had a correction and research is telling us there is a better approach to what we need to be doing, then that is a strategy session going forward. There's nothing you can do about the past. So if you find that it's not achieving your objectives, well, get under the hood. Make a few adjustments. You don't have to change the whole engine out, but just make some tweaks and adjustments that are necessary to get it tuned into a way that gives you the highest probability of success of achieving your objectives.
Okay. And you mentioned Stephen Covey with the end in mind, and I've also heard that, investing is kind of like a journey for some people. Do you have any success stories for that you can share from some of your clients?
Sure. I can tell you the stories about where people got so emotionally involved. 2020, we all experienced a pandemic across this country. We experienced the impact of the uncertainty of the markets as COVID was impacting. And so a lot of individuals moved to cash. Okay. At that point, they were like, hey, we don't know what's going to happen in the markets. We've got supply chain problems. We've got contraction in the market. We don't know how long this is going to play out. And so people made adjustments, and that I can't say that was not the best approach, but they moved into cash or cash equivalent positions. The problem is they got so paralyzed based upon what had happened that they never re-engaged back in the market.
They never left the cash position.
They never left the cash position. Well, the market, if we're looking at the S&P or if we're looking at the Dow, look at how much the market has returned since that point. How much money did those individuals lose because they got paralyzed based upon that information?
They missed all
the return. That's where you need to be working with a planner that can help navigate that can take that emotion out of it. Using research, using guidance of what the markets are showing us. The markets don't repeat, but they do often rhyme. So we may not get the exact same result, but we may get something very similar.
So that's some really good information. What are 2 or 3 things our listeners can do to prevent themselves from falling in, getting off the trail, getting off track?
Well, one thing that I tell my clients all the time is if it's raining outside, you don't have to step outside and look up at a cloud to see if you're going to get wet. If the markets are down, don't open that statement. Don't look to get bad news. If the markets are down, just don't do that to yourself. Just set it aside or give me a call. Let's talk through where you are, what your concerns are, so that I can reestablish why we're doing what we're doing. What is research telling us? Mm-hmm. Make sense for us to make a change? Or is it something that might just be what we refer to as a correction based upon a news clip? How many times do we see the market have a contraction or a small change in a week because of a news cycle clip?
Right.
And a week later, everything is sunny and bright and the day and all the flowers are growing again. But if we would have reacted to the fear of what happened and we abandoned our strategy and the market went down and then it recovered and we missed those recoveries, that's where we fall short of achieving the returns necessary to make our plan become a reality. And so we've got to stay our course. But again, it's about proper allocation of your money. If your investment strategy is one-dimensional, then you don't have a strategy. You have bought a solution. But that strategy may or may not achieve the objective you're looking for. If you're working with someone that has really built out a plan that incorporates the investment side of it, the income side of the strategy, opportunities to and flexibility to pivot when pandemics hit or large market contractions, or even in the situations where we've seen impact due to tariffs or other things that you can't control. Is your plan flexible enough to kind of detour around those and then get back on the plumb line so that we have the highest probability of success? Again, work with someone who is building you a plan, not selling you strategies.
Okay. How do other products like insurance products fit into that type of strategy?
Well, insurance companies often have solutions that may work really good for the first bucket.
Okay.
Due to...
And what's the first bucket?
The first bucket's going to be money that you're looking to use maybe in years 0 to 3 years.
So shorter term.
Shorter duration.
Okay.
Because you don't want to put a lot of money over into bucket one. So if you're using products like fixed indexed annuities that the insurance companies control the return that you get because you are actually sharing in the return with the insurance company, but yet they're the ones that can modify annually what the return is, that might not be in your best interest.
Okay.
Insurance companies, and specifically we're talking about the use of annuities for income planning, those can be some of your best resources because it doesn't matter what the market's done. If you have structured a guaranteed income stream from an insurance company, it's based upon the claims paying ability of that company. So if you pick a company that has good reserves, they have a good rating, you have a high probability that that company will be in place and that your check is going to be in your mailbox or in your bank account every month so that you can live the lifestyle that you've always dreamed of. It's the same approach of what you see with a pension. Okay? Pensions are annuities. Social Security works very similar to that. Lotteries are annuities. So those are resources. So yes, use of an insurance company might be a part of an overall strategy that works for you. What doesn't typically work is to take your life savings and move that over into insurance products, annuity products, thinking that between your spending habits and inflation, that 5% would be a rate of return that would get you all the way through retirement. That tends to not be the highest probability of success. You may make it. I can't say that that solution is based on what age you are. That solution may work for you, but if you're a 60-year-old that may be retiring early and you go into an insurance product that may or may not keep up with inflation, that may not really achieve your long-term objective. It may protect the principal and it may protect the gains that you experience each year, but once you start taking income out of it, it may not be able to keep up with inflation. That's where using annuity products along with investment products tend to give you a nice balance.
And having somebody who can run point on that, an advisor, there's a big benefit in that.
Well, I'll put it this way. If I was going whitewater rafting, I want a guide. I don't want to get in a whitewater raft and start going down a stream and get into some really treacherous situations there, Bradford, without that guide on the back of the boat to help kind of navigate through that. As a financial planner, that's the way I see ourselves, is that those that work with our company, we want to be that guide that, when it's calm water, Everybody says, well, I don't need a guide.
Everyone's a great sailor when it's calm water.
Everybody's a great sailor on calm water. It's when it gets into the white water, it's when the waves start coming that you really need to have that person to navigate and guide you.
All right. Michael, that's a lot of great information. Thanks for sharing all that. If you want to learn more, you can always go to investinginfaith.com, or you can call the number
at 855-378-1806. 855-378-1806.
All right. Thank you so much, and we'll see you next time.
Optivize Advisory Services, LLC, Optivize, is an investment advisory firm registered with the Securities and Exchange Commission, SEC, under the Investment Advisors Act of 1940. Registration as an investment advisor does not imply a certain level of skill or training. The oral and written communications of an advisor provide you with information about which you determine to hire or retain an advisor. For more information, visit https://advisorinfo.sec.gov and search for our firm name. This presentation has been provided for informational purposes only and is not intended as legal or investment advice or a recommendation of any particular security or strategy. The investment strategy and themes discussed herein may be unsuitable for investors depending on their specific investment objectives and financial situation. Information obtained from third-party sources is believed to be reliable, though its accuracy is not guaranteed. Opinions expressed in this commentary reflect subjective judgments of the author based on conditions at the time of publication and are subject to change without notice. Past performance is not indicative of future results.